Folks, it's starting to happen. Small multifamily, 5 to 40 units. C class values are starting to drop. Prices are starting to drop. We got taxes. We got insurance. We got uncertain buyers. We got high rates. We've got NOIs collapsing. Is the Class C value drop finally here? We're going to talk with Cody Davis, who is in this space, owns some stuff, always shopping for more. Cody, what you seeing out there, brother?
Prices are definitely coming down. Luckily, I've got long-term debt, so I don't have to sell. But I was looking at doing a 1031. I had a building on a 39-plex I own. A year and a half ago, it appraised for 3.8 when rates were up, when uncertainty was up. And now finding a buyer for 3.4, 3.5, it's tough. And I'm seeing the same thing on stuff I'm looking at buying. A year and a half ago, I was looking at buying a place for $1 million, cash them out, getting conventional financing. The rate environment hasn't changed too much, but the NOI on that property specifically has gotten slashed. Taxes doubled. Insurance is more than doubled. And there's a lot less buyers for that type of asset. So what I was looking at buying for $1 million, now I'm looking at buying for $750. And I don't think they're ready to swallow that pill yet, but they do need to sell. So,
but it's coming. Yeah. What again, folks, we're talking about 5 to 40s here, maybe 5s to 30s, whatever it is. But basically, this is something I've believed for a while because I shop here as well. I own this stuff and I'm looking to buy more. And there's been such a gap between, sellers who think it's 2022 and, buyers who think it's, 2012 or whatever it is. And this is going to come to bear. You can't hold out forever. If you need to sell and you missed your window at $1 million and today is 750, it could get really bad. I mean, I remember a building that was trying to get 1.444. We ended up buying for 700 because what happens in these bigger buildings, at least bigger than residential, is if you're in trouble as an owner, you just start bleeding that thing dry. And what you will eventually do, they all do it. It's just total slumlord behavior. But you start cannibalizing units. It's like, oh, this unit's toast. I'll take the sink. I'll take the toilet. I'll take this. I'll take that. To kind of band-aid these things together. And the other thing that I'm seeing right now is we saw, and the reason I knew this pain was coming is we saw cap rates. Again, I know my market. You could tell me yours. My market for C-class stuff was always about 8.5 to 9 cap rate on an NOI. NOIs are down, as you've just highlighted, a big way. But 2 years ago, 3 years ago, people were paying 5.5.
wow.
That 5.5 is going to get reset to not only 9, but probably 11 as we go back to, we swing the other direction. So prices just have to collapse in some of these older C-class properties, in my opinion.
Yeah, and stuff's been trading here around 7+. I like to buy 8 to 10, and I'd done that for a lot of my deals, but the market is around a 7, and they'll appraise at 6.5. So things appraise higher than they'll even trade for more often than not here. But the problem is, one example, my Quincy 13 unit, again, that 5+ building, insurance went from $4,300 to $15,700.
Woo!
And
wow.
I can afford it. I've got more than enough cash flow, and I still pay myself out every month on that. But on a value approach, like if you're looking at the income for the value, $11,000, $12,000 hit almost it's multiple. Well, it's not multiple, but it is 6-figure hit to the value. If I want to go and sell it,
let's just do the math, right? So what he's talking about there is the $11,000 hit to the NOI, right? So $11, and you said it's about a 7 cap?
Yeah, it's a 7 cap.
Wow, that's almost $160,000 in value just because of insurance.
Right. And if I had to sell, that would really suck. It
would really suck.
But luckily on that one, I have 30-year fixed rate, full AM, no balloon. That was my first seller finance deal. But
nice. That's
happening portfolio wide. So you figure if that's one building out of maybe 10, the net worth swing can be awful.
Yeah, so let me ask you a question. That's a crazy hit. So I own a lot of this stuff. You went from, I want to get the numbers again. It went from what to what again? Insurance.
43. It was like $4,316 a year.
All right. So I'll call it $4,000 to easy math to 15.
15,700.
Oh, I'll call it 16. Oh my God. Why? Why? Just because of age?
Well, here's the awful thing. So I was grandfathered into a program. I was with AmFam, American Family,
Yep.
and I replaced all the heaters to Cadet. It didn't have in-unit heating. It was all wall heater, like plug-in. It was awful.
Mm-hmm.
So I put in Cadets,
Yep.
replaced all the electrical panels. I had Zinsco,
Ooh.
and
Yeah.
so I replaced 100% of those. And I've talked about that on a past video with you. And so everything was upgraded. I installed gutters and had proper drainage 10 feet away. So underground piping. I tried to bulletproof this building.
Mm.
And they still raised my rate. And they said, this is the cheapest we can get. And so I might have to shop it around a little
Okay.
bit, but I'm not going to get below 12. I haven't seen anything for that type of valuation because it's a $2 million building.
Mm.
And so
Yeah.
I don't see getting coverage much cheaper than that. So the rates going up have really killed a lot of equity. It's killed a bunch of cash flow.
For sure. It's $1,000 a month, a little more than $1,000 a month. That hurts.
Yeah. So I went from 5 a month to 4 a month. So
Yeah.
but it cash flows, but it still does suck. And if I ever did want a 1031, that kills some of my options. The same thing on my 39 plex. The valuation goes down $500,000. Luckily, I bought it at a good enough basis, but $500,000 could buy me a lot more in property. It's another $2 million on my purchase.
Correct. Yeah. You go 25% LTV. That's a $2 million swing. Absolutely.
Yeah. So,
Yeah.
but it's not just happening to me. It's happened to a lot of people, and you got to position
That's
yourself.
Yeah, that's interesting because one of the things that I came to prepare to talk about today is something I heard Ben Mala say on the Iced Coffee Hour, and now I'm hearing Pace Morby say it over and over. And it's basically it's time to lowball, right? We are in a buyer's market, not a seller's market. So yeah, it sucks to be an owner today with your net worth swinging, but I think we got to look at the other side. If Ben Mala's telling us this, if Pace Morby's telling you this, if I'm screaming disrespectful offer, it's time to get super excited because to your point, everybody is feeling this pain. So it's time to get super creative. I actually expect this next 18-month period, Cody, might go down as your best time because you have 4 or 5 years of experience. You know what to do and not to do. You have a track record of seller financing as a great reference base. I actually look at you just to crush it the next 18 to 24 months on the acquisitions. What do you think?
Well, I'm a week out from closing that 5-plex to 9-plex conversion. So
Yeah.
that's still moving. But yeah, coming in at a price and a basis that makes sense for you, I think I'm going to really focus on that with the older stuff. In the beginning, I was giving them their price, getting my terms. Now I'm coming from a perspective, okay, I want my price. And
You
I'll
want
give
the
them their
cake
terms.
and you want to eat it too.
Well, and I'll give them maybe a little bit better terms for their side, but
Sure.
I do want a better price because if I can get better basis, my goal is to transition my old portfolio to new stuff.
Yeah.
After having my first brand new property that was built in 22, I just want more. It's so much better. And so I want to get a better basis on the old stuff when I can,
Right.
so that I can have an easier transition up, even if we do have jumps in insurance, jumps in taxes. I just want to account for that on the buy side.
Well, let me play with that a little bit. Let me poke at that a little bit because I think that's an excellent strategy. Actually, one Olivia and I have talked about doing as well. But I want to play out the next 18 months just to see how this works. So over the next 18 months, I believe, these are just my opinions, they could obviously be wrong. I think the older stuff, which is what we're talking about, is where the opportunity is going to be. And then what you could do if you get creative and you secure at the right basis in the next cycle, which again, dude, you're not even 25 yet, right? So the next cycle, you might be 32. You could 1031 out of those into newer stuff. Am I thinking what you just said correctly? Or is it, Zuber, I'm going to dump the old stuff and go new right now?
Well, my goal is if it makes sense, I don't need top dollar. Something I'm big on is I'm willing to pay top dollar if it's what I have to do to get started. But I don't need it on the exit. If I can move it from what I have to what I want to do, I'll do it. If they're like right now, there's a couple brand new 7-plexes next to mine. I could buy each one with $350 down. So if I could sell one of my older buildings and maybe not get top dollar, get $150,000 haircut, but buy 2 brand new 7s, I'd do that. But if I couldn't do that and I didn't have a clear solution, I have no issue holding out on the old stuff.
Got it.
But I see the old stuff as a means to create value.
Yes.
And then I want to secure it with something that's stable, because I've already paid myself out more cash flow with my 7-plex in the first 4 months than I would in maybe a year or two with an old building, because
No,
I don't have the
agree.
uncertainty.
Yeah, I agree. Yeah, this is what we all kind of learn as we cut our teeth in the market. We often come in and buy the older stuff because it's cheaper, more creative, but then you get into the daily grind of owning old stuff, and it just bleeds you off a little bit by little. So I think, I've been asked all the time, like, what's the perfect portfolio? I'm like, 20 brand new single family homes. Those work for me. That would be like, if I could wave a wand, I would do that every time. But yeah, I think there's a lot of value in new, but to your point, you got to create value where you can. And I think where you're going to create value over the next 18 months is the older stuff. And then you will just manage it through a cycle. And then you will exit in 5 to 7 years into 10 7-plex that are brand new. That's what I see coming for you.
I think so. And having that scale at that point kills the vacancy risk, because that's the problem. If you're getting into new construction early, you get one new 7-plex, someone leaves, you have a $2,000 a month hit. You probably can't stomach that very well. But if you had 10 of them, the odds of 10 people leaving all at once is rather low.
Right. Yeah. So I think it's going to be very fun to watch you do this. Yeah. And you're documenting this all on YouTube, right? What's your YouTube channel?
Yeah. Cody Davis Business Adventures.
Cody Davis Business Adventures. Great name. What are your closing thoughts? What are you doing with all this?
I'd say just be careful and really underwrite carefully when you're looking at purchases. It's easy to buy stuff, but it's hard to manage your way out of a bad deal.
Amen.
Sometimes it's not possible. So make sure you're underwriting for the higher costs on the front end. And no matter what you do, no matter how deep you go in underwriting, make sure you got long-term fixed rate debt.
Yes, please.
A little bit of margin, please. Like, that's saving me right now. If I had to refinance anything in the next couple of years, which I don't, I'd be feeling a lot more stress.
Yeah, absolutely. Cody, you're amazing, man. Thank you for coming back each and every week. Keep it up. Keep rocking. You are an inspiration to more people than you know. Thanks, Cody.
Thanks.